Welcome to the SDA Housing Podcast, brought to you by NDIS Property Australia. Before starting this episode, we need to provide a general disclaimer. Information contained in this podcast is general in nature only. It does not take into account the objectives, financial situation, or needs of any particular person. You need to consider your financial situation and needs before making any decisions based on the information in this podcast. And you should consider seeking independent and professional advice for your personal circumstances. All right, let's begin.
Hello everybody, my name is Minh and I am your host with Rob from NDIS Property Australia, and you're listening to the SDA Housing Podcast, a show that explains, highlights, guides and brings awareness about all things SDA in this ever-changing NDIS world. Rob, how are you?
Yeah, good, thanks, Minh. Hello everyone.
Are you excited? Are you excited on today's topic?
Yeah, well, it's a topic that we've obviously touched on and discussed over a number of months, so it's worth bringing it to the attention of the investors.
Now, I want to tell our listeners right now that we're only doing this because this article is in the news, right? Rob's a little bit hesitant. I'm saying, no, don't worry about it, mate. It's all public news now, so we can talk about it. So don't worry, Rob. It's all good. You're safe behind me, mate. So the Australian Financial Review was issued only 6 days ago. The Fin Review, September the 9th, 2022. It was online, and the article was called "Too Good to Be True: Spruikers Feed Disability Homes Frenzies." And it says, as it starts up the article, mum and dad investors are lured into disability housing with the promise of high government-backed returns and the chance to contribute to society. Well, isn't that true, Rob? Isn't that what the industry is all about?
Correct. Yeah, that's what we tell our investors as well.
But apparently, there's this news article is talking about the negatives or seeing it in a different light, I guess. So let's look at the article and let's analyse not word for word, but paragraph by paragraph, what they're saying in here. So first line says, the suburb of Plympton, southwest of Adelaide, is hardly the epicenter of the nation's fading property boom. But if an independent valuation is to be relieved, a block of 9 units under construction in a nondescript cul-de-sac will, upon completion, be worth $7.5 million. That's an eye-watering 12 times more than the $570,000 paid just 5 years ago for the 4-bedroom house that stands on an irregular block of land. Cool. So it's highlighting the fact that there are developments like this around the country, Rob, where people are just knock down rebuilds to create SDA projects, which we've covered before, haven't we, Rob? It's one of the strategies in the marketplace, yeah.
Yeah, and you've got to remember here that where this article is a little bit not misleading, but they're obviously coming at it with a particular perspective, is that they're talking about the uplift from 570,000 to 7.5 million. But you're going from one property, an old house, to a number of units. So people have to take that into account, that it costs millions of dollars to construct these as well.
Correct. So the federal budget has committed $700 million a year for SDA, correct? So as of June 22, there was $271 committed for SDA payments already. That's a fraction of the $20 billion annually. So currently in 2022-23, the budget for the NDIS is $35 billion at the moment, and that's going to skyrocket to $40 billion a year for the next 4 years as well. The next paragraph says, the scramble to capture these cash flows is attracting sophisticated institutional investors such as Macquarie and Goldman Sachs. The SDA housing as a sector of the property market has grown to $2.5 billion sector since the scheme was set up in 2016, but is forecast to grow to $10 billion by 2030. But SDA properties have also attracted a cottage industry of property spruikers that are luring retail investors with promises of exciting high yield returns. Rob, what does a spruiker mean?
Spruiker is a bit of a negative connotation for a property salesman who is going out and just obviously talking about all the potential good reasons for investing in property. But it has probably a negative connotation. It probably goes back to the 1980s, 1990s from your hometown in Brisbane, Queensland. We had the salesman who used to sell people properties that were inflated in value. So I think that's what they're meaning by spruikers. But spruikers is just someone who's obviously going around talking about the benefits of this particular asset class, which we do as well, but we're doing it in a way where we're obviously giving realistic assumptions and details to investors, whereas this article is suggesting that others aren't doing that.
The next paragraph says unrealistically high returns. So, Rob, I mean, a few years ago, maybe 2 years ago, when the prices of land and build costs were much lower than today, which is 30% lower than today, would you say that the 15 to 18% yields were possible and achievable back then?
I think the 15% was, even with two high physical tenants. And as you said, if the property cost was $200,000 to $300,000 less, we were seeing calls that it would be 20 to 25% 2 years ago from some of these groups that they're now looking at. So 15 was realistic. It was 20, 25% now then, whereas now they're talking about sort of 15 to 20.
So what it says here is disability housing opportunities are being sold hard to the public through targeted AdWords, websites, email marketing, campaigns, webinars, and follow-up calls. Okay, the marketed yields range from 10% to more than 20% and are sold as safe, but because the payments are made by the government while contributing to social welfare. It's an investment that they say will deliver spectacular profit, but to also make life better for the others at the same time. Such aggressively marketed investment opportunities, some operators fear, are grossly inflated, misleading, and will inevitably lead to a swath of vacant homes built in the wrong places or configured for a larger population of high care tenants that then actually exists. Feedback, Rob. Do you agree with all that or not?
Yes, and we've been saying that on this podcast for the last 3 months as to what the pitfalls are and what people have to watch out for. You have to build these in the right locations with research. We're only ever suggesting 2 tenants in a high physical home rather than 3. So this article is just talking about everything that we mention and go through with investors anyway. So all of that's fine.
Correct. Next line says, the corporate watchdog says it's on the alert about promotions that make reference to the government backing and called these schemes an emerging area of interest after receiving complaints. Now, what kind of complaints do you think people would be doing or saying to the ASIC about this matter?
Okay, when they're referencing government backing, I think that's where they're potentially complaining. There may be groups out there that are saying that the government guarantees the rental for 20 years once you build these properties. Now, as we know, the government's guaranteeing the rate of rental return for that time period at this stage, but they're not guaranteeing you a tenant. And in order to get that government return, you obviously need the tenant, because what you have to be aware of is that the funding that the government gives yearly for SDA homes is actually attached to the participant's plan. It's not attached to the investment property. I think that's key. But maybe there are groups out there that are making it appear that people will definitely get the rental return no matter what, and that's what they're worried about.
Exactly. So a spruiker would say to a mum and dad, don't worry, invest in the NDIS. This is government backed. The government's paying all the rent. And it's great. It's great yields, great returns. Now, in theory, that's right and wrong. The government does pay the income via the housing provider only if the participant is funded for SDA income. And that's if they qualify for the high needs qualification process for the SDA income there. As Rob just said earlier, the income follows the participant, not the home. Okay? So when people, and these people are basically real estate agents, right? Or property marketers, they're giving these unrealistic returns, don't believe them. So Rob, what is realistic returns, Rob? What say you?
Well, we've talked about this on numerous occasions, and we outline it with investors. You should be expecting anywhere from 10 to 12% gross which then will become anywhere from 8 to 10% net, is sort of the range that we're dealing in and seeing in these type of properties. If it's improved livability, it might be a little bit lower, but you're anywhere in the range of 6 to 10% growth net returns, which is still very attractive. But it's not going to be 15 to 20.
My personal answer to your response there, Rob, is slightly adjusted. I'd say the gross is probably 11 to 13, that range there, and the net is probably 8 to 10.
Yep, and
would that be fair? That's fair.
Yeah, well, it obviously depends on the opportunity in the properties, but we've had access to properties where it is probably 11 to 13 over the last few months. So it just depends on where and the category and which state.
Yep, okay. So the chairwoman of the ASIC, Australian Securities and Investment Commission, says all of those things need to be looked at very carefully and with some scepticism. At the same time, institutional investors worry that the prospect of investor losses and poor outcomes for tenants could dent faith in what they believe is a scheme that is improving the lives of disabled Australians. Correct. The sales pitch to the public seems compelling, a trifecta of high returns, low risk, and the chance to make a difference. True.
Yes.
That's true. Yep. Another pitch is rental yields of 12% that come from the power to change lives. An email marketing campaign even spruiks 18% annual rents and double that in capital gains for those who get in quick. Oh my God, Rob, your thoughts? Double that in capital gains.
Yeah, well, that one you have to look at and run away from really quick if they're suggesting that off the cuff.
Well, use the common sense approach, people. 18% annual rents plus double that, which is 36% capital return. Okay.
Yeah, well, that may be possible if we've talked about strategies where you may be able to on-sell these properties to investment funds in the near future, but you certainly can't be assuming that may be the case. And we've got no idea what's going to happen with capital gains. We could have drops in value over the next 2 years.
So the AFR, Australian Fin Review Weekend, is aware of at least 9 operators promoting investments that they say will deliver annual rental incomes of between 12 and 20%, while also making a positive contribution to the community. Understating the risks and complexities. This is from a company saying, it is the perfect example of impact investing wherein you are positively impacting society and also generating high returns for yourself as an investor. Yeah, that's true. Unlike investing in other real estates, since the SDA is run by the government, the risks here are much lower. The so-called investment nature of it, that drawing on the heartstrings is something we're looking at, court says. It's part of the overall pitch for these sort of schemes. Another way of enticing people to put their money into these kind of investments. So those sort of statements understate the risks and complexities of operating as an SDA, says Michael Lynch, who oversees the Synergist Fund, which this year has secured $137 million mandate from Goldman Sachs Asset Management to invest in SDA housing. Lynch says that it's important that investors do their due diligence thoroughly and gain an understanding of the risks associated with investing in what is a very nuanced and complicated space. So, Rob, can you please explain to our listeners the kind of approach from a compliance point of view, a fund manager like this, Goldman Sachs, Macquarie Bank and Australian Unity, what's the kind of approach that they would be doing with their board of, internal compliance and investment analysts? How are they doing it differently in their analysis compared to a mum and dad?
Well, they'll probably go into a lot more detail, but they're not doing a lot differently to what we do. For example, when we offer these properties, they're going to be looking at the supply and demand both now and into the future in particular areas. They're going to look at what's being built, what the projected returns are based on being conservative. So whether it's 1 or 2 tenants, 1 for apartments or 2 for houses. They're also going to probably have far more eye for detail on the type of properties being built in terms of the design and the room layouts and whether that is going to be livable for the participants. So that's probably an area where your mum and dad investors don't think enough about. Is this home going to be suitable for a person with a disability to live in? And is it going to be a better layout and design than other homes on the market of which they could switch from? So I think the fund managers that we talk about, that's a big focus of theirs, to look at the design and the livability 5 years out or 10 years out, because they've got a much longer time frame for this sort of stuff than perhaps your average investor does.
Correct, because these guys, the fund managers, are outlaying much more money than the average mum and pa, and it's not their money too. It's actually their investors of their fund who go in there at to achieve their 8, 9, 10% returns as a fund on a fund level.
Yeah, so and they're looking for that specific return. They've got a specific return in mind that they're happy with, that they're trying to achieve.
Yes, and they will de-risk the approach and strategy as much as they can in order to achieve that 9, 10, 11% return, yeah. The other difference, Rob, is the fund managers take a long-term view than the average mum and dad. Won't you agree, Rob, with the approach? On a fund level, they have a large pool of funds allocated to a asset class. They'll have liquidity issues, meaning tied in for 6 months or a year or whatever, redemptions. The approach from a funds management point of view is definitely very much different from a retail investor.
Yeah, it will be. They'll be looking at 10 years plus, up to 20 to 30 years in this sector. They're not coming into it to make a quick buck and then get out. They're making a long-term commitment.
Correct. So, moving on. Vacancy mismatch. It says here, whilst SDA is funded by the federal government through the NDIS, payments are only received if participants are living in the property, and these properties need to be well located, built for purpose, and of high quality in order to be attractive to participants. So Michael Lynch, again, the chairman of the SDA Alliance, a co-op with of many different SDA players in the game, which represents the best practice SDA market. The SDA Alliance pushes a guide to investing in SDA on its website, which I'll read in later on in this episode. We do see examples of where the risk of investing in SDA are understated, most noticeably vacancy risk, as SDA payments belong to SDA participants, not the house, and it is designed to generate choice and control for NDIS participants as to where they live, he says. To be clear, this is not a case of government funds being misdirected. Rather, it's a case of private investors being pitched high rental returns that may not eventuate. The common feature of the pitches is to advertise high rental returns that are based on the assumption that all units or rooms are tenanted by what are known as high physical support participants. Your thoughts, Rob?
Oh, that's everything we've touched on and talk about. That there is a predisposition to talk about the high physical support participants and the houses for that, which, as we know, there's only a small demand of about 7 or 8% of the total participants in that sector, and most of the houses are being built to that general purpose.
Exactly. We've always said so many times between you and me, Rob, if you are going to build a HPS house, 4-bedroom, first of all, don't assume that you'll get 3 participants. Assume 2, right? And even if you were lucky to get 3, assume a different tenancy mix, as in 1 HPS, high physical support, 1 fully accessible, and 1 improved livability. Okay? That is probably a realistic goal to achieve if you are an investor waiting for your house to be built to be tenanted by participants. I think the worst case scenario is really 2 or 3 of the improved livability participants. That's probably the most likely worst case scenario, I think. Yeah.
Yeah, which is still going to be $75,000 a year, so it's not the end of the world.
Yes, exactly. So moving on in the article here, it says here HPS is it's talking about the here we go, Domicom. Let me read this. HPS is the designation of the participants in the scheme that have the most needs. HPS property therefore requires additional design features such as alert systems, intercoms, emergency power supplies, and wide entrances. This sets the dwelling up the house as an HPS tenant and qualifies for the highest payments under the SDA pricing matrix. For instance, the product disclosure statement for the 1 Birchmore Close project produced by the investment platform Domicom said an annual return of more than 14% could be achieved based on all 8 of its units securing $91,882 annual payment that arises from housing an HPS participant while providing on-site overnight assistance. Domicom said in its marketing document that the configuration of the block with 8 HPS units and 1 for a carer means it is independently valued at $7.5 million upon completion. The values vary as the higher the standard of NDIS housing that is provided, the higher the gross rental income that can be derived from the NDIS participants, the document says. The discrepancy in information about vacancies, however, is glaring. So, Rob, that goes back to that original first line we mentioned about that Adelaide unit development there.
Correct.
Rob, can you explain what the Domicom platform is?
The Domicom platform allows a property to be put in a fund and fractionalised. So instead of an investor having to buy and build one of these houses for $800,000, $900,000 as to what we're talking about, the fund buys and builds one of these or 2 or 3 of these properties. In this case, it's 7 units. Then they fractionalise the ownership. So there might be you could effectively put in $20,000 or $30,000 as an investor and own a very small percentage of this particular property. So the advantage of that is that for investors who only want to invest a much smaller amount, it allows them to do that. So it's a little bit like most investors will have heard of property trusts, both listed and unlisted. It's a little bit like a version of an unlisted property trust. Now, the reason why this article has come about is when they talk about ASIC getting involved and looking at this sector, is that what Domicom and others are doing is classed as a financial product which comes under the guise and authority of ASIC. That is very different to what we're doing in selling direct property and doing a build approach. That is not considered a financial product and doesn't come under the guise and purview of ASIC. So that's why this article's come about in what groups like Domicom and others are now moving the sector towards, which is a financial product in a fund.
Yeah. So if we can step back a little bit, Rob, let's go back to the basis of a Domicom transaction. So they are a company which has an AFSL license. They'll create a PDS. Is it a PDS, I assume, or an IM, Rob? What's the scenario here?
Probably a PDS.
Yep.
Sometimes.
What does PDS mean? What does PDS
Product
mean?
Disclosure Statement, which is just the legal document that has to disclose everything to do with the investment. The investment itself, it's the marketing document, but it's also the compliance document where you have to outline all the risks, all the costs, all the fees involved. So it can be, 50, 100 pages long, big glossy book that covers off on all the compliance.
So I'm going to go on a whim here and just have a guess of what this transaction would have looked like from the very start. So they would have maybe found a site, knocked it down $570,000, and did a PDS to do 8 units here on this one block in Adelaide, right?
Correct.
They'll say that they need to have $5 million to acquire the site. They would do a pre-valuation with a valuer in advance, saying it's worth $7.5 million. And you know what? It probably is, but I'm just going to say what the process is. So they say $5 million is the acquisition price for the land and the build, right? As an example, I don't know what the numbers are. So they might need $5 million to acquire, and they might raise $2.5 million. So $2.5 million raised from 200-300 investors, $20,000, $50,000, $100,000, whatever the numbers are. Raise $2.5 million, get a commercial loan of $2.5 million, which is 50% LVR. So there's the $5 million total funds to build, knock down, and develop and get it all done. And then the valuation says it's worth $7.5 million.
Yeah, correct.
Right? So,
that's exactly what they do.
So that's the process right there via that PDS, I think, would have happened. Yes.
Yes.
Now, whether they actually fill it up with HPS participants or not, that's another topic I don't know about. It's probably covered in there, saying they're working with providers, and there's strong indication from the comfort letters that they will have, 6 or 7 or 8 participants who may be IL, FAs, and a handful of HPSs. So who knows what that is? But that is the process of a fractionalised transaction with a lot of people going in with small amounts of money. Yeah. But Rob, at the end of this, right, when they actually build it and they fill it up, what's the outcome for the investors who went in on a fractional basis?
I think they'd actually talk about it further in the article, but this obviously involves a lot of cost. You've got a lot of different parties involved. You've got the legal, you've got the product disclosure statement, you've got the Domicom fees, you've got the fees of the financial company that perhaps is offering it to their clients, and then you've got the commissions that are paid on that. And I think it talks about the actual investor is probably looking at around 11% upfront as a fee.
Mm-hmm.
So if we're talking about one of these properties through us, we could build for $800,000 or $900,000. That's equivalent to an $80,000 to $100,000 that comes out of the investment returns in the long run in fees. Now that's fine. That's the trade-off for having the safety and the comfort that you're doing this through a fund and having everything done for you. That's just one of the trade-offs, that it does obviously cost more to do this that way.
So Rob, just compare this to a managed fund, right? So someone puts in 20 grand into this whole fund, and the return is 10% yield for the year. So they'll get what distribution of income from the units of the trust, is that right?
Yeah, they'd get a distribution after all the costs. So there's going to be a management fee. We've got all the costs involved. And then at the end of the day, they'll get what's left over in the rental. And I think with these particular investment offerings that are actually been in the marketplace for the last 1 or 2 years, it ends up being around 6 to 7% is what the real return is.
Yeah.
Because what they're also saying with this that we haven't touched on is that in their original marketing, they actually include an allowance of 5% per annum capital growth in their figures. So it's 13% roughly for the income, and then a 5% capital growth, which is where they get the 18% overall return.
Now, if I was an inexperienced investor and I saw the returns 18% return per year based upon 13% gross yield and 5% capital growth, to me that sounds pretty good, Rob. I don't know what's wrong with that. What are your thoughts?
Yeah, no, it is. It is a good return if that's, but remember that's the gross, not the net.
Yeah, and also, Rob, it's only if they deliver those numbers.
Yes,
right?
Correct.
No one has a crystal ball. No one knows there's going to be 5% capital growth. No one knows that. No one knows what the actual tenancy mix will be in the complex. We've already covered funding. SDA funding from participants is very complex to figure out from a provider level, right? So unless someone has a crystal ball, mate, I'd say 18% return as a guess is a little bit, too positive in my view. I would always assume 1 or 2% capital growth in any direct property scenario. 1% is a nice little figure. 30%, as you and I discussed many times over, that's a pretty, good best case scenario, 13% gross yield. I think 10, 11s is probably realistic, 10-ish. Minus cost is down to, 7, 8.
Yeah.
7, 8 plus your 1%, 2% capital growth. There's your 8, 9, 10%. Yeah, not 18%. Okay. So if you're an investor who only has, a few bucks and can't afford a big $900,000 investment property, then sure, throw in a 50 grand, 20 grand, 10 grand or 100 grand cost into this fund, but you're simply a unit trust holder who's going in there on a fractional level.
That's correct. So you're paying for convenience.
Yes, exactly. Now moving on, the next paragraph is oversupply is inevitable. One provider, SDA Housing Investments, said investors were able to find tenants in nearly all cases for units and some in houses. The oversupply risk was for high-rise apartments for HPS tenants. They are only 8% of the participants and attract the highest investment return, so an oversupply is inevitable as all investors want these tenants as a priority, he says. The HPS payments can be double that of the lowest of the 4 designations, and promoters are explicitly pitching the configuration as a money spinner. A block of 9 units in Mandurah, Western Australia, marketed by, can I say the word, Rob?
It's up to you. I probably wouldn't, but
Well, starts with an A, ends with an R. ASR Wealth. Hello, boys. How are you? ASR Wealth. And I'm just reading an article here, Rob. This is a public document here, so I'm not trying to hide anything here. Marketed by ASR Wealth, for instance, is promoting 18% plus returns based on specifications that attract the highest SDA payment. Wow. This rush to allure investors might explain why there's been a surge in properties with nearly 6,000 places built to HPS standard level. Fund manager Barwin estimates that there's about 60% of the new build supply is for HPS, I think, although expects fewer than 20% of participants will probably be funded at the HPS level at the scheme maturity. Probably 10%, really. So there you go, Rob. ASR Wealth. Who are those guys? I think they're a planning group in Sydney, I think.
Yeah, a share recommendation company, I think, that's obviously expanded into this sector as well for their client base.
So again, guys, listeners, why would you take property advice from a stockbroking firm? You know, promoting 18% returns plus returns. Well, look, if they achieve those results in that block of 9 units in Mandurah, kudos for them. Congratulations. You did well. But if you don't achieve those results for your clients, then that's a tarnish on their brand, isn't it? So, look, we're not saying who's right or wrong. We're just saying, look, this is what the article says, right? And no one has a crystal ball. We hope that those investors get their good returns out of it. 12, 13, 14, 15. 18 is a bit too high, I think, but we'll see what happens in the long term. So moving on. At present, about 27% of participants seeking an SDA dwelling are funded at the HPS level. Okay. The rush to market the highest possible returns for the lowest outlay also appears to be resulting in properties being built where land is cheapest, not where the demand for disability housing really exists. Rob, that's a great line there.
Yeah, what you ideally want is land that is cheap, but where there is also demand. Because we talk about, obviously, the return and the yield is higher if your land cost is lower. So it is almost the opposite to what a traditional property investment should look at. You should be looking at location, and the higher the land value, the better the investment. In this case, it's more of a commercial property, industrial property type return where it's yield driven, as we discussed, rather than capital growth. But yes, you're not going to be building these in the middle of nowhere. You still want them to be in areas that have got all the infrastructure that we've talked about, hospitals, transport, shops. So that's critical.
I think investors need to have their own playbook, Rob, because everyone's different, right? If you are a astute, normal residential property investor, you would analyze your data, your information with historic capital growth in the area, the population of the suburb, the amenities being shopping centres, hospitals, doctors, surgeries, coffee shops, the walk-by score. Those things do apply to a normal property. And if the SDA investors can apply some of that same concepts to SDA itself, right, that should be a good guide. Now, what you just said there, Rob, close to amenities, right? Not in the middle of nowhere. That's a very powerful line there. Do not build SDA property in the middle of nowhere.
Yeah, well,
in the middle of nowhere means in the middle of nowhere means there's no transportation, no bus stop, no hospital, no library, no coffee shops. That's some common sense here. And what this article is referring to is some investors are building cheap SDA properties in the middle of nowhere because the land is cheaper. So using common sense here, why would a participant in a normal community move all the way out to a brand new HPS house in the middle of nowhere where there's nothing out there? No friends, no family, no amenities, nothing. So, and we're seeing a bit of that at the moment, Rob, and it's painful to see. It's just because at some point in the future there will be an oversupply of stock in certain areas, and those participants are smart. They will choose the better ones near the proximity of hospitals and shops and employment, I guess. Yeah.
Yeah, correct. It doesn't cost the participant any extra money to be in a better located house that is of a high quality. So, of course, they're going to choose that if they can.
Yes. So, too good to be true. But as a new sector, we want to ensure investors' capital is being allocated responsibly in a way that aligns with participant objectives and the principles of the NDIS. This is Joz from Barwin Investment. He says the fund, which has 46 million invested in the sector dwellings, is taking a long-term view by identifying communities and cohorts that are underserviced and then providing desirable accommodation for people with disability in these locations. Good work, Jaws. Good work, mate. So Jaws has done a podcast with us. It's going to be published in the next few weeks. It'll come out soon. We had a nice 45-minute podcast recorded. And
good timing.
Yeah, good timing. He's actually in this article as well. Moving on. And also, Jaws contacted you as well, Rob, about STA as well, didn't he?
Yeah, correct. We had a good conversation about opportunities in that sector.
So, as he's saying here, for service providers, the speculative building frenzy is driving growth. ASX listed. Oh, there you go. Domicom is ASX listed. There you go, Rob. ASX listed, which allows fractional investing in properties by creating pooled trusts, says its funds under management have grown 6% in a year to $134 million. So there you go.
Yeah, so there's obviously a lot of people investing in through this structure, and it's probably going to increase.
Yep. A key factor driving the bounce was increased advisor syndication for NDIS transactions executed through Domicom's investment platform, it told its shareholders last month. An analysis of Domicom's One Birchmore Close property marketed by ASR Wealth reveals upfront fees and costs equate to 11% of the initial investment. There you go.
Yeah, that's where I got that figure from earlier.
Good. Okay. So, Rob, is 11% in fees a little bit too much to charge an investor to go into an investment?
Well, it's a lot, but that's the issue with doing anything through a managed investment scheme and a product in the financial services sector is because of all the rules and regulations and compliance that they have to follow. And the good thing with that is it gives investors protection. If things go wrong in future, they have recourse to do something about it. But that obviously means that costs explode, which eats into the investment return. So you're giving up significant investor return in order to have a little bit of security potentially going forward to do with your investment. But people just have to weigh up whether they're better doing it with a little bit more of a direct approach as we offer, because the net return will be significantly higher.
So the last two lines are, that includes a fee paid to the financial advisors of 4.1%. Domicom and ASR Wealth had not responded to requests for comment at the time of publication. Why not, boys? Domicom, ASR, don't be ashamed of your commissions. Moving on. Headline claims. Court says ASIC is not the regulator of property investments by individuals. Its jurisdiction only kicks in when it becomes a managed investment scheme, MIS. But references to government backing are causing the regulator to concern, and is looking into these proposals closely. I don't want to say none of these are good investments, not for a minute. What we're really trying to say is you have to be careful of these kinds of headline claims about guaranteed returns. Your capital is safe. And in particularly, the whole idea about being government backed. This has the potential to lead people into believing that their capital is guaranteed and they are not going to get guaranteed returns because somehow the government is standing behind them. There you go. While the new pricing structures and high building costs have led to a modest slowdown in NDIS property sales blitz, the well-honed pitch remains alluring, high returns, low risk, and a contribution to society. So it references a salesman here. This program is a beauty, says the salesman on a promotional video on the NDIS investing website. With the global slowdown upon us, what better place is there to be than in a government-funded investment program? There you go. End of article. So we've covered every article word for word. Rob, final words of advice or comments about this article, please.
Oh, look, it raises some good points. And as we've discussed what that means, investors have to take that into account as to which way that they want to head, but just do it with their eyes open. Look at realistic returns rather than returns that might be a little bit unrealistic. And they're still contributing to a sector. So a lot of their claims are completely correct. You're doing a good thing for society and getting a decent return from it.
Exactly. I got a few notes here from my other presentation I did a few days ago in another event, and it says here, I wrote down, the cause of a vacancy in SDA is when the developer and builders are not listening to the market because they aren't always correct in their analysis of the data. A single location rather than dispersed, diverse locations. High density of participants in one location, in one development could be an issue. It's not demand or participant led. The design is poor, poorly partnered, meaning the SIL providers could have been chosen better, and poor quality finishes. So my final words of advice to everyone listening is, bad locations and bad designs don't get tenants. Okay? Rob,
Right.
that's all for me.
All right.
Anything else for you?
Yeah, no, great. That was enjoyable. Hope everyone liked it and will get a lot out of it.
Yeah, look, I'm sure not everyone gets a fin review because it costs too much to pay for the online subscription. I finally paid for it and I read the whole thing, and I thought I'd raise it as a podcast topic because this is public information, this article. So it's not like I'm making up this gossip from these companies here. This is on the news, and I wanted to raise, we want to raise to our listeners that some of these issues are relevant to everyone. And at the end of the day, be very careful with your decision making in investing. Seek advice, seek professional, legal, financial, tax, and property advice from your consultants in your life, because it's hard. This is a very complex transaction, whether you're going in as a fractional investor or as a direct property investor, either inside or outside super.
Well said. Yep.
Thank you, Rob. Thank you very much for your time. Appreciate your efforts on helping me go through this article today.
All right.
Bye-bye.
No worries, Min. Bye, everyone.
Bye.
We hope you enjoyed this episode. Please make sure you are subscribed and following us so you can keep in the loop with all of our upcoming episodes. We would really appreciate it if you could leave us a 5-star rating, a written review, and to share this podcast with those that could benefit. Until next time, catch you on the next episode.